Says investors should look to quality when building their portfolio and has a few names to watch. We're joined by Piper Sandler Chief Investment Strategist and Head of Portfolio Strategy, Michael Kantrowitz. Michael, great to have you here this morning. We'll certainly get to your definition of quality stocks and which ones might qualify, but curious about, reiterating your macro view. I know you've been pretty resolute in feeling like we have a pretty standard macro cycle underway. Script is kind of written. We're going to slow down. We have lag effects that have not yet brought us into recession. Where do we stand in that process, to your mind?
Yeah. Hi, and good morning. In terms of where we see the cycle going, we just continue to see a slowdown in certainly leading indicators. Today, we got the ISM manufacturing index, which all components are now in contraction territory. And ultimately, our focus this year and increasingly in the second half is all about employment, because employment is the make or break variable between a soft and hard landing, between a market that can continue to rise after the Fed is done tightening versus a market that rolls right back over. And we still see enough convincing evidence that we're on the path to something that looks more like a harder landing down the road rather than any kind of cyclical pickup in the near term. And I think market leadership year to date is a very clear reflection of that. A narrow market, a narrow macro backdrop of data recovering, while the broad economic and earnings data and employment data continue to slow.
Yes, you have pointed out that there often is this window when those types of stocks, maybe a handful, do a lot of the work. People celebrate perhaps a Fed pause, and maybe it's a harder landing than the optimists think. I do want to get to, though, how you think folks should be positioned in terms of your quality screens. I know that there are some simplistic ways of looking at the quality factor. I look at the ETF, NVIDIA is the top pick. I mean, the top weighting. Microsoft's in there. It looks like the NASDAQ. How do you interpret it?
Yeah, and it's pretty much looked like the NASDAQ for the last 15 years. And so, quality is one of those phrases investors like to talk about, but always have very different definitions. And part of it does depend on where we are in the profit cycle. Quality last year is very different than quality this year to some extent, because the broad earnings growth story is very different this year. It's far less broad-based than it was last year. So when we look for scarcity, or what's becoming more increasingly scarce, it's earnings growth, it's near-term earnings revisions, it's companies that have high profitability with not a lot of variance or not a lot of cyclical exposure. So it's really flavors of avoiding the cycle or cyclicality and maintaining exposure to those companies that can kind of hold up the best in what we see as a continued challenging earnings backdrop.
And I'm just looking at the screen of types of companies that have entered it. I mean, you do have things like Lennar, which, of course, is a home builder, and Pool Corp and Brunswick. These seem like durable goods companies. Is this just about, the factors you mentioned seem to be lining up and they're not overpriced yet, or how do they get in there?
Yeah, so one of the successes of our models, which have outperformed both the large cap index, the growth, and the value index, is that it's sector neutral. And so we're always trying to help our clients that have to be more or less fully invested or look for areas to put their money. And so we're always looking within sectors. So it's not just go buy tech or go buy profitable tech, but go buy profitable industrials, go buy growthy real estate stocks, a sector that's been under massive pressure for a while. What's working there, the growthiest, most profitable names. So what we look for is companies that kind of rise to the top within their peer group. And that's, I think, ultimately how most institutional investors, they can't just buy one sector and avoid the other 10. They have to find kind of a broader exposure. So those names that pop up kind of look for the best of breed within their peer group.
Well, I guess in the first half of the year, you could have bought one sector or at least 7 stocks that would have generated some decent returns. I'm curious if you think the narrow leadership will continue in the second half of the year, and if it will be that same kind of big tech, AI exposure, AI excitement type names that will drive the market higher in the second half of the year.
Yeah, I'd argue and kind of push back on that idea. Yeah, I mean, maybe retail investors could, but institutional investors cannot. Some of them can't even own to the extent that some of these names are as big as they are in the S&P index. 7, 8, 9%. There aren't too many investors, active managers that can have a size that large. So they, in a sense, are kind of running upstream in the composition of this benchmark. Will those factors continue to work? I believe so, yeah. And, there's a big debate about, whether recession's coming or when it's coming and if it's coming. We're thinking of things more in a spectrum. Will data continue to slow, and when will that stop? When will that story change? When will we see a broad-based recovery? Because a broad-based market recovery requires a broad-based macro recovery. And with the Fed still tightening, emerging developed economy, central banks still tightening, oil already having massively eased over the last year, there's not many more pockets of stimulus that can re-accelerate this economy. So we expect growth in earnings to continue to decline alongside other coincident and now lagging indicators like employment data. So we still very much believe you want to be in the same types of areas of the market. Again, names that are profitable, have great balance sheets, good free cash flow. This is not the time to buy highly deep value cyclical names hoping that we're going to see a broad-based macro recovery. We just don't think that's on the cards in 2023.
All right, Michael, appreciate your thoughts today. Thanks so much.